Hello, everyone, and welcome to an exciting webinar on taxes. And I got to congratulate you for signing up for a webinar on taxes. I know there's a lot of other more exciting things perhaps you could be spending your time with today. And yet, is there anything more important than taxes? I mean, that is such a large part of our financial life. I'm really excited that you've agreed to join me today. My name is Brandon Green, and I am the CEO of Alchemy of Money, and I've got all kinds of interesting content for you today. As we get started, just maybe put in chat, where are you coming from? I'd love to see where we've got folks from. I know we have members here at Alchemy all over the country. I myself am in the East Coast today and am excited to be talking to you a little bit more about your taxes. I know we've got some folks in the Midwest that are popping online. That's fantastic. California is always showing up strong. I know we have a number of our tax members in California, and Texas is another place that we've got some folks. Looks like Sherry coming in from Texas. Maryland, yes, right up the street from me. It's exciting to see my Maryland family come on in. Delaware, just around the corner. Florida, Georgia, Michigan, Ann Arbor, a lovely place to be. Fort Worth, Kim Carter, bringing the energy. We can always count on our Texas folks to be bringing the big energy today. Harold from New York, welcome, Harold. Really excited that you could be with us here today. So as we get going, if you've got some questions that you'd like to post in chat, I'll do my very best to get to as many as possible. This presentation is designed to give you some really good action items to take away for your taxes so that you can really improve your situation this year. And I really like this presentation because it comes from the perspective of both the tax professional and the real estate entrepreneur. So let me explain a little bit about what I'm talking about. So my background, I started in real estate in 2001. As an agent, selling houses, and then grew a team, and then grew a brokerage, and learned all of these lessons, frankly, the hard way. And all the mistakes that I'm going to talk to you about today, I've made these mistakes. And so I grew a large real estate practice. Eventually, I sold that and realized that there was really a big opportunity to help us in our industry with taxes. So I eventually launched a tax firm, which is what you see today, Alchemy of Money. And so I have a very unique perspective on this body of work. I see it from the entrepreneur and real estate professional's perspective because that's been my career. And now that I own a tax firm and employ accountants and CPAs and all kinds of incredible professionals, I see it from that perspective too. So I asked my team to help me understand what are the biggest mistakes that agents are making right now so that I could help you help yourself in thinking through what you may want to adjust or change in this tax year. All right, so let's dive into it and see what we can discover. Number one is not communicating expectations and, dare I say, important trigger issues is a mistake that I'm seeing people make. I'll give you a good example. So I mentioned in the intro there that I got into real estate in 2001, and I had some great success early on. I sold 12 million and then 20 million and then $30 million in real estate within a few years. And after a few years, I'm literally driving to a showing, and I had this inkling. I was like, wait a minute. I think I need to pay my taxes. Wait, do I file? Like, how do I? So if you're doing the math, you're realizing that I have 3 fantastic years of production and hadn't paid any taxes. And that really set me back early in my career. It was a very painful experience. And so as I went forward in my career, one expectation I had, and frankly, it was a bit of a trigger for me, was not having any surprises come tax time. So what we've noticed here at Alchemy, and we're working with agents all over the country and helping them with their tax strategy and tax compliance and everything in between, is that everybody comes here with some sort of expectation, and in some cases, bad experiences that create potential issues. And having that clear at the beginning really can help. So look, the partnership you have with your tax professional is a two-way street. So the one thing that we're seeing folks make a mistake with today is not necessarily communicating what those expectations or trigger issues might be. Let's face it, it's a little embarrassing. I mean, the fact that I'm standing here today and hosting a webinar and telling you that I got way behind in my taxes in my career, like $500,000, let me tell you, that was very painful. And it informed my perspective later on. So hopefully you haven't had that extreme of a situation, or maybe you have, or maybe it's something much more minor, though we do find that there's a lot more success in our relationships with our members and in our ability to deliver great value when those things are communicated in advance. So, it's like when you're working with your buyer and seller, sort of same idea, making sure you all get on the same page of your expectations. Okay, this is a good one. I like this one. Number two, and I'm looking at several of you right now on this one, and this is not paying enough of your taxes quarterly, and maybe not even saving enough for the end of the year true up. So let me get into some details on this. So you may or may not know at this point that as a self-employed individual, the IRS requires you to pay your taxes, any taxes that are due, on a quarterly basis. So while we reconcile the details on an annual basis and submit that to the IRS, the money is actually owed quarterly. And if you think about this, this makes sense, because if you're a W-2 employee, you actually pay your taxes through the paycheck withholding component every other week or once a month, however you're paid. And so the IRS said, hey, for self-employed folks, like, we're not going to wait all year to get the funds. Like, we want to get those funds quarterly. There are several challenges within that. One is knowing how much to pay. If you end up paying less than you owe, then you could very well be hit with penalties and interest. And those penalties and interest are a lot higher than you might expect. So I remember this. After I got out of debt with the IRS and clawed myself to the surface there, I was feeling pretty good about myself. And I began making quarterly payments. But what was happening simultaneously is my business was continuing to grow. And so I got to the end of the year, and my tax professional at that time said, hey, congratulations on the growth this year. Congratulations on pulling yourself out of that big, deep hole. And you still owe more taxes. And I was like, what? But I've been paying quarterly. And he said, right, just not enough because your business grew. So not only do you have to pay a minimum amount per the estimation from previous year's tax return, you actually need to be paying in enough based on this year's income. So two practical considerations. One is make sure that you have those quarterly payments schedules in your calendar. And you know exactly which link to go to for federal and state. And you've already set up the online account, and you've gotten from your tax professional, whether you're working with us here at Alchemy or you're not yet working with us here at Alchemy, your previous tax professional, make sure you get those numbers so you know what you need to pay so that you can avoid those really unnecessary penalties and interests. And realize that you've got to true up that information. Here at Alchemy, we true up that information both in the summer and also towards the end of the year. And that way, when you come to tax time reconciliations in Q1, you don't have a big surprise. So we see a lot of folks that just simply are either not paying quarterly or they're not saving enough towards the end of the year so that they have the ability, based on how their income has increased, to go ahead and make that payment. Now, Joe has asked a really good question. I'm sort of seeing it here in chat. Are there in various ways that you can reduce those tax liabilities? And yes, there are. And I'm going to get into some of those in a second. But number two is making sure that after you deployed your tax strategies and after you've done a lot of good stuff, that you are making those payments on time and that you saved enough powder to make it towards the end of the year. I hear a lot of people are like, well, I don't want to give the government a loan. Totally get it. But if you don't send the government the right amount of money, you will end up paying the government extra interest because they effectively gave you a loan. So make sure you sort of get that right. That can save you at the end of the day a lot of pain, a lot of hassle, and a lot of money. All right, number 3 is you might get to the place where your liquidity is too low to actually execute your tax strategies that interest you. So here at Alchemy, we do a lot of tax planning. It is really the centerpiece of the work we do. We do tax work, we do bookkeeping work, but it's really the tax planning that a lot of people are really excited about. So in the summer, we're looking at all the opportunities that you could do, whether it's paying your kids a salary and taking that as a deduction for the business and giving that opportunity to your kids to put money into an IRA. Like there's a lot to that. Maybe it's contributing to your retirement plan, or maybe it's investing in a new rental. But here's the deal. Like all of that stuff that you might be interested in doing requires cash. So in the world of tax, there's no freebies. That's the interesting thing about it. Like, well, I shouldn't say never. Like once in a while, the Congress passes some sort of free rebate, and all you have to do is like fill out a form. But that's really unusual. The way it generally works, right, is the IRS says, look, you got 2 options here, folks. You can either pay the tax to the government, or you can pay yourself in the form of an asset investment and receive a credit or a deduction as a result of that. The theory being like, if the government says, if you pay us, the government, then we'll take care of you when you need to be taken care of, and or you need to take care of yourself by buying assets. So we get a lot of folks that come to Alchemy. They're like, hey, I want to do this strategy. I want to do that strategy. I want to do this strategy. And they're a little sometimes surprised or disappointed when those strategies themselves cost thousands upon thousands of dollars. So make sure that you do the planning in the summer so that you're saving enough cash from your business or your other endeavors so that you've got the liquidity to actually pull together all the great strategies. One of my favorites, of course, is buying rental properties. And well, we know, right, we're in real estate that actually costs some money. You got to like put down the down payment and so forth. But there's a lot of them like that I think what we tend to see is folks want the tax benefits, but don't necessarily have the cash in order to deploy and get the great deductions or incentives that the IRS code has set up for you as a result. So number 3 is making sure that you have set aside enough money to deploy some great tax strategies. Well, what strategies are relevant to you? Well, that is work that is done in the summer, so that you've got the rest of the year to deploy it. And I will also add one more thing. Most all tax strategies have to be done by the end of the calendar year. So, if you're in your, whatever year you're in, like you got to do them that year. A lot of folks will get to the following year and say, hey, let's say it's spring of 2026. And you say, hey, I want to save on my 2025 taxes. Well, you're like, well, 2025 was like gone, right? The time to save on your 2025 taxes was in the tax year 2025. So, the time to save in your taxes for this year is actually this year. The strategies have to be deployed this year. There are a few exceptions, like you can, for example, make a contribution to your retirement account all the way until you file into the following year. But most of this stuff requires a little bit of setup. I remember we recently had a member who joined us, and they were coming to us 2 different cases. Like one came to us in August and said, hey, I'd like to get a good strategy in place and minimize my tax liability. I've had a really good year. And we had just enough time to do that. We had another member who came to us towards the middle part of December and was like, hey, it was too late, right? The setting up IRA accounts or making large purchases just simply takes time. So you cannot come to the end of the year expecting you're going to miraculously change your tax position for that year. It really all has to be done 6 months prior so you have enough time. Ideally, you're doing this in the summer, but you're certainly not waiting until, I'd say by October, I'm getting nervous for you, right, of the calendar year. So do it as soon as you possibly can. All right, number 4 is being so afraid to actually pay the taxes that you spend the money on something you don't need just for the write-off, right? We do see this sort of towards the end of the year, right? I think car dealers are thrilled with real estate agents come the 22nd or so of December, right? Be like, oh my gosh, I got to get a tax deduction. Let me go out and buy a car. Look, Certainly the truth is that there may be purchases for your business that you do want to make in order to reduce your tax liability. But let's not lose sight of what we're doing to begin with. Like, the whole game here is to help you increase your net worth. And at Alchemy, we want you to increase your net worth, generally speaking, and taxes are a really big component of that. But certainly make sure that you're not like overdoing the tax situation and therefore not actually able to get the overall net worth situation set up right. So I think that's a really interesting dynamic here, is sometimes people are overplaying the tax deduction and buying stuff they don't even really need in order to get the deduction versus thinking a little bit more strategically about what the whole game is here that we're doing, which is helping you build wealth and increase your net worth overall. Well, look, I think this is a good moment just to take a small pause. Like, we do tax work here at Alchemy. We do bookkeeping work, and we specialize in the real estate industry. So I just put up on your screen, if you'd like to book a free consult with us at any time, we'd love to have a conversation with you about how some of these may or may not apply to you and get into some of the specifics. So we're working with people all over the country with tax strategy, tax compliance, tax issues with the IRS, and the accounting side to make sure your profit and loss statements, your balance sheets, and payroll is all where it needs to be. So if we can help you, we love that opportunity. So book a free consult. You can just click that on the screen. If you're driving right now and you're not able to actually click on anything, then you can always go to our website at alchemyofmoney.co, alchemyofmoney.co, and we would be happy to help you with that at any time. All right, well, let's go back to where we were here with the presentation. So we were talking about that number 4 is being so afraid to pay for your taxes, you might just end up getting unnecessary write-offs. Let's go to number 5, which is making strategy decisions based on, friend recommendations, social media, ChatGPT, Claude, you name it, without consulting with your tax manager first. So some really good examples of this might include like cost segregation studies or 1031 exchanges or buying or selling rental properties or setting up new entities. I mean, look, we all have seen the TikTok video that's like, hey, you can buy and you're going to pay nothing in tax, right? I mean, you've seen these. First of all, if it seems too good to be true, right, it probably is, right? Second of all, taxes are really a fairly complicated area. And so one of the mistakes we certainly see people make is making these big strategic decisions without actually consulting with any of your tax folks. So 1031 exchanges are a really good and interesting idea around this. And look, you're in real estate and you've probably seen this, right? In 1031 exchanges, you have for those that don't know, in a 1031 exchange, you can sell a rental property and you can roll the proceeds into a new asset. Now, of course, and not pay any capital gains tax on that. There's a lot of asterisks. There's a lot of this, if, this, right? So, but generally speaking, if you've ever done one of these, though, you know there's a really tight time frame to do them in, right? You have to identify a like-kind property and close within a tight time frame. And we have absolutely seen people, in order to get the tax benefit, rush into real estate purchases that when we then look at the situation, we're like, look, that's kind of a lousy investment. You would have been better off to pay the tax than to buy that lousy property. So, look, and if we'd had the opportunity to have that conversation, then that could have been some insight that we pulled to the table. Or let's take another example, a cost segregation study. So if you don't know what that is, that's where you break up the pieces and parts of a rental property and you can accelerate the depreciation, essentially, or better said, you can take the deductions you might take normally over 20 or 30 years and bring them all forward and take them in a much shorter period of time. It can be a great strategy to reduce your tax liability in a year that you've had a really big income year. I was talking to a real estate agent just the other day, right, that had a couple huge sales all, within a few months of the new year. And it is on track to have an enormously big year, much bigger than he normally does. And he's got a property that doing a cost segregation study right now can help reduce his tax liability this year. But here's the kicker, right? And there's always a kicker, right? There's always a this and that. Like, it's never always free. If you take the tax benefits now, you don't get them later. So the IRS essentially says, look, happy to have you have these tax benefits, and we'll even sprinkle a little bit of acceleration on there, but you don't get them later, right? So in his case, that's going to work. But on the flip side, we had a member join us who did cost segregation on all her rental properties. And then when she came to us and we did her taxes, her tax number was higher. And she's like, wait, why is my tax bill higher? I thought it was going to be lower coming to Alchemy. And we looked at it and we're like, oh, well, because you took all the tax deductions in the past. You just don't have any left, right? So cost segregation can be one of those things that really requires some analysis to ensure that you're doing it at the right time and in just the right way. You know, that could be a huge swing for you. So number 5 is making strategic decisions based on friend recommendations or social media, or without even consulting anybody, ChatGPTing your way to tax strategy and seeing how that works. Tax is simply too complicated not to talk to a professional. So make sure you're very cognizant of that one. Okay, number 6. This one catches a lot of people by surprise. Number 6 here is not planning for payroll and reasonable compensation early enough and adjusting your strategy as your income grows. And I've got a couple horror stories on this one. So first of all, let's talk a little bit about the S corporation. I'm sure, and put in chat here if this applies to you. Do you have an S corporation? If you have an S corporation, then you might or might not know that you have a requirement to pay yourself on payroll. So the IRS, when you have an S corporation, which by the way is generally really good for your taxes if you're making more than $250,000 a year in GCI. Now, this is a generalization. Like everything, don't take a webinar and just go execute a strategy. You need to talk to a tax professional. We're happy to help you at Alchemy, but certainly somebody talk to a tax professional before you execute it. That's my little asterisk disclaimer from our legal department here. An S corporation can be a great thing, but the IRS says, look, you got to have payroll. Like, if you want to be compliant with the S corporation, then you have to run payroll. Well, we recently had somebody join us who had an S corporation, and as we were onboarding her, we said, "Hey, we can't find any payroll information. Like, how much did you pay yourself on payroll last year?" And she said, "Oh, right, yeah, I just never got around to it. I set that S corp up about 7 years ago, and gosh darn it, we just never got around to payroll. Oh, by the way, I also have this little notice from the IRS asking me about payroll too." It's like, oh, okay, well, let's see what that says. Well, come to find out, the IRS had the same question we did, which is, where's your payroll information? Except for the IRS wasn't particularly kind about that. They looked at it and said, oh, you haven't been executing payroll since you started the S corporation, which means you violated one of the principal tenements of having an S corporation, which is actually running payroll. We're going to therefore void that S corporation back to the beginning. Yeah. Tens of thousands, maybe hundreds of thousands of dollars of lost tax benefits simply by not administratively setting up payroll at the beginning and doing it right and paying a reasonable salary, which is a big requirement for S corporations. So in tax world, a little mistake over a while can really be expensive. So it's another reason to have a great professional by your side, making sure that you've got all of the T's crossed and the I's dotted. And look, we're in real estate. And so we also know that income every year goes up and then it goes down and then it goes up. Like, have you ever had a perfectly straight and narrow trajectory? No, probably not. Right. So every year your income is different, which is quite different than people that have a W-2 salary. Therefore, adjusting your strategy as your income grows becomes a really, really important component to making sure that you land on the dot at the end of the year and you've got that tax situation as reconciled as you possibly can. All right. Yeah, I see a couple people putting in like shocking faces, like with that S Corporation story. It is a little bit of a tough one, or a really, really tough one for sure. And you can really get in trouble with that one. Latrice is putting into chat a question of, what's my take on a recent ruling striking down the income tax requirement? Well, I'd say keep paying your taxes. We'll see what happens. Keep paying your taxes. That's our take on that one. Number 7 is making any big decisions without clean books. And look, intuitively, you kind of get this already, right? Let's say, for example, if you signed up for a coach because you wanted to grow your business, and the coach said, well, how much do you want to grow your business by? And you said, I don't know, more. And the coach was like, well, okay, great. Well, how many listings did you have last year? And you're like, I don't know, some. The coach at this point might be maybe giving you a side eye. And the coach says, well, how many buyers did you have last year? And you're like, I don't know, but probably quite a few. Well, how many deals did you do last year? Well, tough to say. I'll see if I can get you that number. What was your GCI or your volume? I don't know. You're asking too many questions. How in the world is the coach going to be able to help you grow if you don't have any grounding in what your numbers are today? Well, of course they can't, right? It's the same, though, in tax land and in finance land in general. And so one of the big mistakes that we see people make is they come to Alchemy ready for the big tax ahas. What are the big insights that we're able to provide on the tax side? And then when we ask for the underlying data, like your profit and loss statement, your balance sheet, reconciled financials, are like, oh yeah, well, I was going to have to do that. So big decisions often come abruptly and suddenly. Huge opportunities usually come with some sort of time frame or timeline. Things you've got to deal with from the IRS have a date stamp by which they must be accomplished. All of that requires you to have really good, clean accounting. So maybe the thing for you to focus on this year isn't as much the tax stuff, it's the accounting. Like, are your books in really good shape? I think it would be really a foolish idea to make tax decisions on whether you should do this or that without the actual underlying data. So number 7 is we see people come to us and they want the outcome. I mean, I want the outcome. Like, I'm a real estate, I get it. Like, I want the outcome. But to get the outcome, you have to do the work in advance. And in this area of tax land, it has to do a lot with accounting, with your bookkeeping, and making sure that's super clean and clear. Now, we have some folks that are like, well, can't AI just do my books for me today? Well, give that a try and see what happens. Right? AI, as we know, is sitting at somewhere around, 70, 80% accurate. So if you're happy with your tax return being 70 to 80% accurate, well, then go for it. If you'd like your tax return to be a little bit more accurate than that, then you've got to get your books to be a lot more accurate than that. Which, by the way, I'm not saying you got to have 100% accurate books. There's too many pieces that are moving around. And when I refer to books, I'm talking about a statement of your income and your expenses and what's left over in the form of a profit and loss statement. A statement saying what your assets and liabilities are in the form of a balance sheet. That needs to be, I'm going to say, 90% accurate, and that can flow through to a really good, clear picture for you. So number 7 is often just making big decisions without the benefit of that underlying data. You wouldn't do that in your normal sales business, right? You wouldn't decide to hire someone if you had no idea how many sales you had last year, would you? Right? So consider that it's the same idea here in tax land. Okay, number 8, and this one certainly can be fun, and this is confusing cash in the bank with taxable income. All right, raise your proverbial hand if you tend to manage your finances via your bank app, and that's it. Right? Like, well, log in the morning, and if there's enough money in there, then I guess I'm winning, and if there's not, then I guess I'm not. Right? Well, the challenge with that is that's not really how business finances work. And it's certainly not how taxes work. And you might know this. If you ever got to the end of the year and your CPA or your tax professional was like, hey, congratulations, you had a great year. And you asked yourself, gosh, I wonder where all the money went. right? If you have a profit and loss statement, you may have even gotten to that really weird spot where your P&L, your profit and loss statement says that you actually had a net profit at the end of the month. But then you look at your bank account and you're like, that's not, where'd the money go, right? So the answer to that could be a lot of things. Probably you distribute it to yourself, right? So the money probably is in your personal account. But I think the overall thought is that cash in the bank is one thing. Profitability is another thing. And then just to make it a little bit more complicated, like what your actual taxable income is an entirely different thing. So you could have cash or no cash, profit or no profit, owe taxes or not owe taxes. And those things, while in the same general family called finance, are really not related. So think about your skills this year. Do you need to better your skills in reading and understanding a profit and loss statement? Maybe that's the idea. Do you need to better understand the correlation between profitability and taxable income? Maybe that's it. Or maybe you are ending the month and you're like, I've got, some or not enough or whatever cash in the bank, and it doesn't match my expectation or my picture of my finances. Maybe now's the time to really dive into that. So take a look at that. Alexander posted a really good question. Like, what are books? And David, I thank you very much for answering that. Indeed, that's what I mean. Books are a report that shows you what your income and your expenses are and where the income and expenses came from and how much you actually had left over. And that is referred to as a profit and loss statement, or sometimes it's also referred to as an income statement. And then the secondary report is called a balance sheet. And the balance sheet is showing you what your assets and your liabilities are. So start with the profit and loss statement and then work to a balance sheet. And if you have an S corporation, you're required to submit a balance sheet to the IRS. All right, great. Let's go to number 9. Number 9 is not having a tax manager who explains your taxes clearly, and therefore you just really have no idea what in the world is going on. Look, I remember as I was continuing to build my career, the more properties I bought, the more I got involved in, the more complicated my taxes became. And it got to the point where they were, tens of pages and then a couple hundred pages long. And my tax professional would send me the file, with 2 days deadline and be like, hey, anything look wrong? And I'm like, I have no idea, right? Sign, and off it went. Well, after a few years, I got a nice little package in the mail from the IRS saying that I had been pre-selected for a multi-year, multi-entity audit. Yeah. So what I quickly discovered in that audit process is I am responsible for my tax picture. The auditor didn't send an audit notice to my tax manager. The auditor sent an audit notice to me. The auditor didn't have questions for my tax professionals, although they were there to help. The auditor had questions for me. So if you are in that spot where you're like, oh my gosh, my taxes have just gotten so complicated, let me just sign here. Let me ask you to just take a little tiny pause and do one thing a little different. And we do this as part of just what we do here at Alchemy, and that is have a little review of your tax return at the end of the year before it is filed. Now, sometimes that can simply be, a video. A tax manager can create a video and say, here are the highlights. I'm not suggesting you need to become an accountant, but I am suggesting that it's really important for you to know what the hey is going on with your tax picture. I mean, you are, after all, submitting to the federal and state authorities a very intimate picture of your finances. Wouldn't you kind of want to know maybe what's on there? So a 10 to 20 minute call or a video can go a long way. And if you do that year over year, it elevates your level of responsibility in terms of your understanding of your tax picture and also really seeing what is going on. I think you'll find yourself to be far more empowered around that idea, around your taxes rather, with the idea of taking a little bit of time for a review. All right, so just a little pause here. I just want to, once again, for those that maybe have joined us a little bit later, to remind you that, hey, here at Alchemy, we do taxes, tax compliance, tax strategy work for real estate professionals around the country, both real estate agents, and I see that there was a question in the chat there whether we work with real estate investors, and the answer is yes, we do. Real estate is our expertise. We'd be very happy to help you And you can book a free consult at any time. And so just click on that button and book a free consult. And if you instead would, because you're driving or something, if you want to go to our website, it's alchemyofmoney.co, alchemyofmoney.co. And of course, we'll have a follow-up email that will go out here a little bit later that will have this presentation and then some additional information about us. So just want to make sure you've got that here as we start to round the corner here. So number 9 is not having a tax manager who understands your situation, and therefore you don't really know what's going on with your taxes. And you may someday get an audit notice, and gosh, wouldn't it be nice to kind of know what's happening? Number 10. This is one of my favorites. Maybe it is the favorite of the day, is not having a planning meeting with your tax manager early enough to review your situation and structure. You might have noticed that tax professionals in the spring are exceedingly busy. The government has organized this situation where everybody's stuff is due on just a couple of dates every year. 300 some odd million people have to create reconciliations by just a small handful of dates every year. It's a little chaotic in the spring for tax professionals, which means the spring is not the time to do your tax planning. The time to do your tax planning is in the summer. The time to have conversations about your tax situation is earlier than you're doing it now, most likely. So if you're waiting until Q1 or Q4 to have conversations about your tax situation, and you do nothing else as a result of this webinar today, you do one thing, I'd ask you to move those conversations around your taxes into Q2 and at latest Q3. If you do just that, it's going to make an enormous difference in your situation in terms of your tax liability, your stress level. You'll be able to sleep better at night because you've had those pre-planning meetings well in advance of what's happening right now in terms of the tax season. So this is a really, really big one to get well and to get right, is to have these tax meetings early. All right, so now I want to do a quick lightning round of some of the changes that are in effect now as a result of the big, beautiful bill that was passed recently. Look, there are a lot of changes. Many of them are deep in the weeds technically, but I wanted to pull out just a few that I think are particularly relevant. And this is in a quick lightning round for everybody who's listening today. The most important things that I see as part of this big, beautiful bill that I think make the most sense for you. Number one, and there's just a few of these that I pulled out for you, is the SALT deduction. That's the state and local tax deduction, went from $10,000 to $40,000 through 2029. So if you're a top producing agent in a high tax state like Maryland, Virginia, California, New York, and you previously hit sort of that $10,000 wall, well, now if you're paying, $35,000 in state income taxes, you can now in most cases deduct all of it. So that's a really nice change for real estate professionals. So that's a big one. And that's also relevant potentially for your clients. All right, number two is mortgage, and this is really important for your clients. Mortgage insurance premiums are now treated as deductible interest after December 31st, 2025. So look, there's always asterisks, there's always exceptions to these rules, but mortgage insurance premiums were quite tricky previously, but now they are back. Number three is agents who set up home offices, purchase vehicles, or invest in technology equipment. You can now fully write off almost all that cost immediately. You don't have to deduct it over multiple years because bonus depreciation is 100% back, and it appears to be permanent, or as permanent as things can be these days. And the next one is opportunity zones. So these are really relevant for your investor clients, maybe yourself, if you're looking to defer capital gains from great property purchases and sales. Opportunity zones, which had phased out, are now back. And then there's two more that I think are really interesting. This next one is, remember these 1099 thresholds where if you had like a showing agent or anybody in your organization that made more than $500 a year. I mean, the limit was low. You had to issue a 1099 or 600. Actually, it was $600. Well, that was kind of annoying. Now the limit is up to $2,000. So that's really helpful. That 1099 reporting threshold has moved from $600 to $2,000. And third payment networks like Venmo and PayPal, and I know a lot of people use that, have kind of reset their thresholds as well. So, at the $600 level, like everybody, it seemed like, had to get a 1099, but now at the $2,000 level, that is, I think, a little bit more manageable. And this one is kind of interesting, right? New on the scene, starting in tax year 2026. There's the new Trump savings account, right? So tax advantage investment accounts are now available for anybody under the age of 18 with a Social Security number. You can have annual contributions up to $5,000. Those are non-deductible from any source, and those earnings grow tax deferred. So that's nice. And then any child that's born between January 1st, 2025 and December 31st, 2028 will receive a one-time $1,000 federal seed contribution. And withdrawals after the age of 18 for education, first-time homebuyer purchases, or starting a business can avoid the 10% early withdrawal penalty. So, hey, if you've got somebody new in your family, that can be a really good way to get them all set up for you. So take a look at that, and that could be a huge opportunity for you. So now on the screen here, you see that we have a nice freebie for you today for joining us on this webinar, which we really appreciate. This is a free write-off checklist, and this is also available on our website at alchemyandmoney.co. Scan this, and this will give you some good tactical insight this year on what you can make sure that as a real estate professional, you're able to write off. Now, spoiler alert, right? That Jet 2 holiday is still probably not deductible. Some of that stuff did not make it into the tax bill. But hey, there are a lot of opportunities. In all seriousness, as a real estate professional, you just have the opportunity to have a lot of different deductions and write-offs. Like I've got folks that come to us all the time, and they're like, hey, should I do this? How aggressive can I? Look, you don't even need to be that aggressive to get access to a lot of the great write-offs, and we're happy to discuss those with you. If you just book a free consult with us, as business owners, as real estate professionals, particularly as folks that own real estate, we have a lot of great opportunities in the code to reduce our taxable income and make sure that we're optimizing the money that we have. And so I've just put up here again the opportunity to book a free consult with us, and alchemyandmoney.co is our website. We're very appreciative of you being here with us today. Thank you for everybody who's participated and booked a few Q&A, or rather have posted a few Q&As in chat. I know this topic can be something that can be, a bit of a mix, like up and down, like it's interesting or it's a little bit challenging, but it's present for all of us. And my hope for you today is that you were able to take one great thing out of the webinar today and move it forward so that this year you have the ability to keep more of that really hard-earned money that you earn. Thank you again from all of us here at Alchemy Money, and we'll see you later.